X 100%. Engineer your financial freedom.
Today, we're going to break down one of the most powerful and, time-tested investment ideas ever created. At its very heart is this beautifully simple concept. What if you could buy $1 of a real, actual business for just 50 cents? That right there is the entire goal of value investing. It's not about chasing trends or trying to perfectly time the market. Nope. It's about understanding a business so deeply that you know without a doubt when you're looking at a true bargain. But to find those amazing bargains, you first have to accept a pretty wild idea about the market itself. I mean, think about it. You've seen it, right? You turn on the news, a stock is soaring one day, and then the very next, it's plummeting because of some vague rumor. You've probably asked yourself, is this whole thing just completely irrational? So much of it seems to be driven by pure fear and greed, by this herd mentality that has almost nothing to do with how the companies are actually performing. Well, value investors believe the answer is a huge, resounding yes. And that irrationality, that's exactly where the opportunity begins. Okay, so let's really get into this. To help us wrap our heads around how to deal with all this irrationality, the father of value investing himself, a guy named Benjamin Graham, came up with this brilliant little story. He wants us to picture the market not as this faceless, giant computer, but as a person. So, come on, let's go meet this character he called Mr. Market. So imagine you're in business with this guy, Mr. Market. He's your partner. The only problem is, he's not very stable. Some days, he shows up just totally euphoric, convinced the future is unbelievably bright, and he'll offer to buy your share of the business for a ridiculously high price. But then, other days, he's just completely depressed, certain the sky is falling, and he'll try to sell you his share for a price that's way, way below what you know the business is actually worth.
Now here's the secret sauce. You are under zero obligation to deal with him. You can just ignore his crazy offers. The real secret of a value investor is to never let Mr. Market's mood swings affect how you feel about the business's real value. Instead, you just wait. You're patient. When he's panicking and offers you a fantastic bargain, you buy. And if he's way too optimistic and offers you a fortune for your shares, maybe you sell. You learn to use his emotional roller coaster as your single greatest tool.
So if Mr. Market's crazy moods are what create these opportunities, how do we get ourselves ready to actually see them and then act on them? What do we need in our back pocket to stay rational when he's being anything but? Well, that brings us right to our next section, the Value Investor's Toolkit. These are the core concepts that let you separate the market's fiction from the business's facts. This slide just perfectly captures the central battle here. On the left, you've got the market price. Think of that as the storm. That's Mr. Market shouting at you every single day. It's emotional, it's chaotic, it's driven by headlines. But on the right, you see the calm, steady reality of intrinsic value. This is what the business is actually worth, based on a cold, hard look at its assets, its earnings, and its future. The entire game of value investing is played right in that gap between the storm and the calm. And that leads us to what is, I would argue, the single most important concept in all of value investing, the margin of safety. Benjamin Graham came up with this, and it's basically your financial shock absorber. It's your buffer. So let's say you do all your homework, you crunch the numbers, and you figure out a business is truly worth $100 a share. That's its intrinsic value. But Mr. Market, in one of his depressed moods, is selling it for only $60. That $40 difference, that is your margin of safety. It's the cushion that protects you if, maybe your math was a little off, or if the company just hit some unexpected bad luck. So, how big of a cushion do you really need? Well, there's no single magic number. But let's be clear, disciplined value investors are not looking for a tiny little 5 or 10% discount. No way. They're looking for a significant margin of safety, usually somewhere in this 30 to 50% range you see here. An investment only becomes truly attractive when the discount is that big, because that's what gives you real protection against all the things that can go wrong in the future. It's what separates smart investing from just gambling. Now, knowing these principles is one thing, but actually putting them into practice, that takes a complete shift in your mindset. And that brings us to our next big idea. Think like an owner. You have to stop thinking like you're just renting a stock ticker for a few days and start thinking like you are buying the entire business, with plans to own it for years and years. Thinking like an owner isn't random. It follows a real process.
It's not about getting some hot stock tip from a friend or a flashy website. First, you screen for potential companies. You use financial data to build a list of businesses that might be on sale. Second, and this is where the real work begins, you do a deep dive analysis. You've got to understand that business inside and out. And then third, only after all that hard work, you try to estimate its intrinsic value to see if that all-important margin of safety is actually there.
All right, so your deep dive starts with the company's financial reports, and first up is the income statement. Just think of this as the company's report card for the year. The big question you're trying to answer is super simple. Is this business actually profitable? You want to see revenues, that's total sales, going up year after year. That shows people want what they're selling. You also want to see stable profit margins, which means they have some pricing power. And finally, you look at that bottom line, the net income, to make sure it's consistently in the black. That's the bedrock of a healthy business.
Okay, next up, we look at the balance sheet. If the income statement is like a movie of the company's performance over a year, the balance sheet is just a single snapshot in time. It shows what the company owns its assets versus what it owes its liabilities. Here, we're just asking, is this business on solid financial ground? You want to see a company that owns way more than it owes. And you have to pay really close attention to long-term debt. Why? Because too much debt is like a giant anchor that can sink an otherwise fantastic company, no matter how profitable it seems.
And finally, we get to my favorite, the ultimate truth teller, the cash flow statement. Look, here's why this is so critical. Accounting profits on that income statement can sometimes be massaged. But cash is king because it's real, it's tangible, and it's a lot harder to fake. This statement shows you where the actual hard cash came from and where it went. And what you are looking for, above all else, is strong, consistent cash coming from the company's main business operations. That proves the business isn't just profitable on paper, it's a real cash-generating machine. That's the lifeblood of any great company.
So once you've looked at all the numbers, there's another, deeper level to the analysis. And this quote from Warren Buffett, it really marks a huge evolution in value investing. See, Benjamin Graham was famous for buying just fair companies at these wonderful, dirt cheap prices. But Buffett realized it's often way better to pay a perfectly fair price for a truly wonderful company that's just going to keep growing and compounding your money for decades to come.
So what exactly makes a company wonderful? Well, it all comes down to what Buffett calls a competitive moat. Just like a real moat protects a castle from being attacked, a competitive moat protects a company's profits from its competitors. This could be an insanely strong brand like Coca-Cola that people just trust. It could be a network effect like a social media site where the more people use it, the more valuable it becomes for everyone. Or it could just be a huge cost advantage that lets them crush the competition on price. A wide, deep moat is what separates the good from the truly great. Okay, so this all sounds great in theory, but I have to be honest with you, the path of a value investor is absolutely filled with traps. And understanding the most common mistakes is just as important as knowing what to look for so you can avoid them. The biggest, baddest pitfall of them all is the value trap. This is a stock that looks unbelievably cheap on paper. All the numbers are screaming buy, but it's a trap. The business is fundamentally broken. Maybe it's in a dying industry or a new competitor is just eating its lunch. The price is low for a very, very good reason, and it's probably just going to get lower. Your job is to tell the difference between a great company on a temporary sale and a broken company that belongs in the bargain bin. This second pitfall isn't on a spreadsheet. It's inside our own heads. It's called confirmation bias. It's this natural human thing we do where we fall in love with an idea and then we only look for information that proves we were right. We read all the good news and just dismiss the bad stuff as noise. The best way to fight this? You have to actively go looking for the opposite opinion. Seriously, try to find the smartest arguments for why your investment idea is a terrible one. It's tough, but it forces you to challenge your own thinking and builds a much stronger case. Okay, we have covered a ton of ground here. The philosophy, the tools, the traps, it can feel like a lot to take in. So the most obvious question is, how on earth do you actually get started? Let's break it down into a few clear, simple first steps.
First, you've got to educate yourself. And the best place to start, hands down, is Benjamin Graham's classic book, The Intelligent Investor. It is literally the Bible of value investing. Second, practice. Just pick a company you know and try analyzing it. You don't have to invest a single penny. Just go through the process to build that analytical muscle. Third, keep a journal. When you analyze a company, write down exactly why you like it or don't like it. This forces you to be clear and helps you learn from your mistakes. And finally, when you do feel ready, start small. Think of your first few investments as part of your continuing education.
Look, if there is only one thing you remember from all of this, let it be this right here. You are not buying a blinking ticker symbol on a screen. You are buying a piece of a real, living, breathing business. Every single decision you make needs to flow from that one powerful idea.
And that leaves us with the final question, the one that every true value investor wakes up and asks themselves every single day. With all the chaos and fear and noise out there, what wonderful business with a great, durable moat is our old manic-depressive partner, Mr. Market, offering us at a ridiculous discount today? The answer is out there. It's just waiting to be found.